Have you been told the S&P 500 is unbeatable? Well, today I'm going to prove that wrong. In doing so, I will show you 3 broad methods I've seen that beat the market, and also I will show you 4 stock market investing systems that have proven to beat the S&P 500 over the past decades. Hi friends, if you're new here, I'm Cody Koch. I'm a 25-year veteran investor and hedge fund trader. On my channel, I talk about investing, trading, and business concepts. So this idea of beating the S&P 500, one of my first early memories related to it is I'd started investing in college. I was an active investor and I'd had some early success in my first few years, and I had nicely beaten the S&P 500. Well, one day I was sitting with one of my college professors. He was a finance professor, had worked on Wall Street, knew hedge funds, knew a lot of things about that world, and I was kind of bragging to him that I was successfully beating the market, thinking that was a big deal. So he kind of rolled his eyes and he said, "Cody, a lot of guys beat the markets." Well, sometime later, I began to realize he was exactly right. Over the years, I've been privy to a lot of different systems. I've designed a lot of my own systems, got to know a lot of other traders and investors, and I've seen a lot of people who do handedly beat the S&P 500. In fact, I want to quote David Harding, founder of Winton Capital, which is the 14th largest hedge fund in the world. David said, "The S&P 500 is a trading system. It's a set of rules for buying and selling stocks. It's just a trading system. And by the way, it's not a very good one." And that too has been my experience. So the S&P 500 is simply an index. It's a basket of about 500 stocks. Actually, it's more like 505 stocks that is based on a set of criteria that are chosen to put these stocks in the index. Every stock in the index must be publicly traded in the United States, has a market cap of at least $8 billion, and the larger the market cap, the more likely it is to be in the index. Shares have to be very liquid. At least 50% of the outstanding shares have to be public. It must have positive earnings over the last quarter, and the last 4 quarters must be net positive overall. And from this criteria, a committee of human beings then chooses which stocks go into the index. That's the trading system of the S&P 500. I should also mention that the S&P 500 is not equally weighted. The top largest stocks make up 30% of the index. The truth is, many systems actually notably beat the S&P 500, and there's many different methods to do so, and I'm going to give you 3 real quick. The first method is kind of obvious. You have a better stock picking system, which I will discuss 4 systems in this video a little bit later. The second method is to invest in other asset classes. For example, if you own a private business, most private businesses significantly make higher returns relative to their underlying investment compared to investing in the S&P 500. Many small and medium-sized businesses, in fact, produce annual returns of anywhere from 20 to 30% return per year on their invested capital. The third method is one of the most powerful methods I've actually ever seen, and that is, instead of buying a portfolio of individual stocks or individual investments, instead you have a portfolio of trading systems or investing systems that are all highly uncorrelated to each other. Because they're uncorrelated, they make very smooth, steady returns, and because of that steadiness, you can then go out and significantly leverage up your entire portfolio. When you do that, you make substantially higher returns with the S&P 500 with substantially lower drawdowns. An example of this would be Jim Simon's Medallion Fund, which historically has produced about 66% return on its money per year since 1988. So now let's go into the 4 stock picking systems I talked about earlier that have been proven to beat the S&P 500. Now first, let's get some context. Going back to 1972, the S&P 500 has produced about 7% per year since that date. So the first is, among all the stocks that are available for you to purchase in the market, you randomly pick 50 of those stocks. You equally weight them, about 2% of your portfolio in each. You hold that position for 1 full year, and at the end of that year, you then rebalance the portfolio by choosing another 50 stocks randomly. Such a system actually has averaged a 9% return per year going back to the 1970s, beating the S&P 500 by 2 percentage points. The second system is called the Magic Formula, detailed in The Little Book That Beats the Market by Joel Greenblatt. The way this system works is you take all the stocks that are available. You then rank them by return on invested capital. Stocks that have the highest return on invested capital have the highest score or the highest rank. You then take all the stocks again and you rank them by what's called earnings yield, which is the inverse of the PE ratio. Stocks with the highest earnings yield, or the lowest PE ratio, have the highest ranking or the highest score. You then combine these 2 scores together and you have a portfolio of stocks that rank the overall highest. You choose 20 or 30 stocks among this list, you own them for 1 full year, and at the end of that year, you rebalance the portfolio based on the same factors. Have average returns about 15.9% since 1972, beating the S&P 500 by almost 9 percentage points. The third system comes from this book, The Acquirer's Multiple by Tobias Carlyle. The way this system works is you rank all stocks based upon their acquirer's multiple, which is taking taking the enterprise value of the company and dividing it by the operating earnings of that company. You go out and you buy the 20 or 30 stocks with the lowest acquirer's multiple, you own them for 1 full year, and then you rebalance the portfolio. Doing that has average returns of 18.2% since 1972, beating the S&P 500 by about 11.2% per year. The fourth system is a trend following system. Now, the way this system works is you go out and you buy stocks that hit their all-time highs. So they're hitting brand new highs never seen before. You then trail a stop loss following those stocks by 10 times their daily average true range based upon the last 40-day average, and you just let it ride. You buy anywhere from 20 to 50 stocks using this method. Over the study period in which this was tested, of course also taking out commissions and slippage and so forth, it has averaged 15% per year compared to the S&P 500 making a 7.9% over the same time period. So quick side note, because of my background as a hedge fund trader, I'm asked often why hedge funds do not consistently beat the S&P 500. Well, the answer surprises a lot of people. Hedge funds are actually not trying to beat the S&P 500. Their primary goal is to actually have the smallest drawdowns possible. And in fact, research proves that hedge funds are very, very good at having much smaller drawdowns compared to the S&P 500. In fact, when you adjust for this, hedge funds consistently make 2 to 3 times the returns of the S&P 500 compared to its drawdown. So to put that in perspective, if you leveraged up the returns of a hedge fund, on average, it would make 2 to 3 times the returns of the S&P 500 with the same size drawdowns of the S&P 500. You can actually see this in research based on the Sharpe ratio. Hedge funds on average have significantly better Sharpe ratios compared to the S&P 500. You can also see this on research based on the Sortino ratio. So I spoke earlier about the acquirer's multiple. Well, recently I did a video on 5 stocks that have the lowest acquirer's multiple. You can watch that here, and I'll see you in the next video. Thank you for watching.